Welcome to this video on cases in tail risk. Tail risk here, we're talking about disasters, crises, failures in either a corporation, an investment, or a fund. Okay, there are 5 market losses for fund investments. Essentially, there are 5 fraud cases, which are a combination of corporate frauds and investment frauds. So there's also a discussion of technology crises causing significant losses as well. We'll find that a theme that runs through these failures, certainly when it comes to market losses, is huge leverage. So why do managers gear up? It's because it magnifies P&L, and we'll have a look at the impact of leverage on returns in a little calculation, which you should be able to do. We'll also think very briefly about behavioral biases impacting investors. You know, psychologically, people seem to repeat the same mistakes again and again. So why is that? We turn to behavioral finance to explain that. Now, just a little health warning before you get into these failures, which are quite interesting because they are, factual, historical blow-ups that have happened. It's interesting to read through these. You don't need to know the numbers. You don't need to know the dates. All right. I don't think they'll test, how much was lost here. What date did they say this? What date did this happen? I wouldn't worry about that. It's more about the lessons. Focus on the lessons that we learn. I've already mentioned one of them because it's on the slide here. Leverage is always there when there's a big corporate or investment blow up. You'll find that leverage is pervasively there unless it's just straight out fraud, in which case, we don't need a massive amount of leverage there. But when it comes to market losses, leverage is always playing a role, as we'll see. So you might find these slides slightly cursory in nature. It's really because they're focusing on what you need to know for the exam, and that is the crucial lessons that come out of these cases rather than the facts of the case in terms of dates, size of losses, that sort of thing. Okay, so the first fund failure due to market losses that we look at is Amaranth, which was a hedge fund which failed in 2006. What's interesting about the Amaranth case study is that in 2005 had a great year. It was up over 100%. And in that year, you had Hurricane Katrina and you had a cold winter, which led to a strategy paying off. They were playing natural gas futures spreads, calendar spreads, where they were going long winter months and short summer months. If you have a cold winter and you also have supply disruption due to a very unlikely and outlier level storm, then you're likely to see that winter contracts shoot up because natural gas is used for heating. Short and summer contracts don't shoot up so much. Okay. And that led to huge profits in 2005. Amaranth essentially banked that and went on to gear into that trade more in 2006, and it didn't work. And they went from a 9 billion fund down to a 3 billion fund. They lost $6 billion by gearing into this trade. They ended up being bailed up by a consortium of investors, including their prime broker. Their prime broker, JP Morgan, actually was part of a consortium which took the assets of the fund off the hands of the fund at a steep discount at distressed fire sale prices and went on to profit greatly from that. So what lessons do we learn here? First up, Amaranth was operating in lightly regulated markets, OTC markets and exchanges, which were allowing large positions to be built. And they did build large positions. Originally, Amaranth was a multi-strategy hedge fund. You would put a massive question mark over that now on the basis that it was primarily engaging in a very concentrated and levered natural gas strategy. They cornered the market here. Estimates are that they had over 70% of the open interest relating to natural gas for certain delivery dates. These are huge positions. And when they suffered losses